This is your technical update from the LMAX Exchange Research and Analytics Desk for Thursday, February 25th, 2016. Euro dollar. So the euro has pulled back in recent trade, with the market trading all the way down below the 110 barrier to the 109.50 area thus far. However, as per commentary in recent trade, the 110 level is going to be a key level to watch on a close basis. If the market continues to hold above 110 on a close basis, this could suggest a higher low by this previous resistance point now turned support in favor of the next upside extension, potentially all the way back towards the 114 area. At the same time, if the market closes below 110, this would suggest a more immediate resumption of the broader downtrend, exposing an acceleration towards the 107.11 area and 105.21 area further down. But again, it's going to be important to keep an eye on 110 today to see how the market responds. A break and close back above recent highs that we saw around 110.53 would do a good job of taking the immediate pressure off the downside. Sterling dollar. So cable has been under pressure, intense pressure in recent trade, breaking down to fresh 7-year lows, and now focused on a retest over the coming days and weeks of that critical psychological barrier and 2009 base at 135 further down. That 135 area also happens to coincide with a measured move downside extension following this latest break below 140.80. At this point, any corrective rally should be very well capped up towards the 142 area, while ultimately only back above 144.08 would take the immediate pressure off the downside. Dollar yen. So dollar yen has been under pressure in recent trade, with the market stalling out back on the 16th of February all the way up at 114.87 and rolling back over to just trade shy of that multi-month low on Wednesday at 110.98. A break below 110.98 will do a good job of accelerating declines and opening the next major downside extension, potentially all the way down towards the 107 area. At this point, a break back above 114.87 would be required at a minimum to take the immediate pressure off the downside. Euro Swiss. So some intense setbacks in Euro Swiss over the past several days, with the market pulling back from that multi-month high at 112 to trade all the way down into the 108s thus far. At this point, looking at the longer-term chart, the market should continue to be very well supported above a multi-week range low at 107.15, with only a break back below to really compromise the more constructive outlook for this market. Still, there is risk for additional declines over the coming sessions into the 108 area and even potentially into the 107s, but again, only back below 107.15 would really compromise this bullish outlook and take the pressure off the top side. As such, moves towards the 107 area should be viewed as formidable opportunities to be a buyer in favor of a higher low and fresh upside extension back towards and eventually above 112. Aussie dollar. So Aussie is stalled out by a key 78.6 fib retracement off of the 73.85 to 68.27 multi-year low move. At this point, look for the formation of a lower top ahead of the next major downside extension back towards and eventually below 68.27. At this point, only back above 73.85 would compromise the bearish outlook for Aussie dollar. Dollar CAD. So dollar CAD is inching closer to that key rising trendline support off the May 2015 low, and once this level is tested, the market might then look to put in a next higher low ahead of a bullish resumption and fresh upside extension back towards those recent near 13-year highs at 146.90. But again, at this point, there is risk for additional weakness towards the 136 handle, which coincides with that rising trendline support. Kiwi dollar. So Kiwi looks to be carving a lower top, potentially around the 67.50 area, ahead of the next major downside extension, which will be strengthened on a break below 65.46, exposing 63.47 further down. At this point, back above 67.52 would delay the bearish outlook, but ultimately only back above 69 would compromise the overall bearish outlook for Kiwi dollar. SPX 500. So the S&P 500 has been consolidating recent gains, but the market overall, since breaking below that critical August 2015 base, has shifted to the downside, and a lower top is now favored somewhere ahead of 1993, some previous support now turned resistance, in favor of the next major downside extension back below 1808, those recent lows, and towards 1700 further down. Ultimately, only back above 1993, or let's say 2000, would really compromise the bearish outlook for the S&P 500. Gold. So gold continues to trade with a strong bid tone following the breakout above 1200 several days back, and the market is now consolidating mostly above 1200, ahead of what should be the next major upside extension to challenge the 2015 high from January at 1307. Look for the market to continue to hold into weakness above 1200 on a weekly close basis, while ultimately only a weekly close back below 1190 would take the immediate pressure off the top side.